All right, folks, welcome back. We're going to continue our lecture on micro market structure and time and price concepts. I'm going to build a little bit on your understanding of my order block theory. So if we are looking at indices or index futures specifically, as we referred to last time we were together, we're looking at the E-mini S&P December contract for 2020. And if you recall, if you have not watched the previous recording, then please stop this video and watch the other one. It's not a very long video. So it helps build a little bit of the foundation. Also referring back to this candle. So if we look at price action like this is a daily chart, I want you to confer with the direction. Where's it been going? Okay, so if we're going to be using micro market structure, that's like the very, very low time frame intraday charts. There are some out there that say that there's just noise on these lower time frame charts. And if you really take a step back and think about it, that's actually impossible. It's impossible, okay, for that to be true because it's the same price. So the fact that we're measuring the fluctuations on the basis of a specific time interval, that's where the confusion comes in, because it becomes a question of what time frame do I use? Which is the better time frame? Is it a 1 minute chart? Is it a 2 minute chart? A 7 minute chart? 5 minute? You can use any lower time frame chart you want, but if you really want to get ultra tight with your entries and stop loss orders, the 5 or 1 minute chart is the best in terms of doing that. But you have to understand what you're looking for, otherwise you will get burned. All right, so I've covered in many videos over the last 10 years dealing specifically with Forex and teaching some of my concepts with that asset class. And many of you are familiar with my time and price theory. I've done videos on that and tutorials, and it's made its way in many of my lectures. And you all understand and have been introduced to my ICT order block theory. So while I mentioned this specific candle last time as a bearish order block and how we can use the low of that candle, and again, I'm going to count you to look at this price up here. So the price comes in at 32.56 and a half. Okay, so 32.56 and a half. We can use that level when we're bearish. So the market has been going lower, and to avoid all of the necessities of trying to pick a bottom in a bear market, you just simply focus on the up close candles. If we get an up close candle while order flow is down, or trend or momentum, however you want to refer to it, but this is how the interbank traders will focus in on key price levels on the lower time frame for entry. Now you're also going to hear hedge fund managers, bank traders don't use 1 minute charts. Well, that's true in a sense, but they're waiting for something specific on the chart to appear to initiate their engagement. So I'm going to teach a little bit of that, and I introduced it in the last video, but I want to build on a little bit here and still try to keep the video short. So we have this level here, and we're going to look at Friday's price action. Now notice Friday's price action is a nice bullish candle. Now it didn't have a whole lot of range, but it was respectable, and it did trade deeper into this up close candle. It does not matter, because if we're trading micro market structure, what we're essentially doing is we're trading the intraday volatility, both directions, up and down. But how can you determine which side of the marketplace has the more likely probability using order block theory? Well, let's go back down into a lower time frame. Okay, so here we have the E-mini S&P December contract for 2020, and we are dialed in on a 5 minute chart. And I want you to take a look at this price action, pause the video, study it for a little while, and come up with what you think you see in this price action. And then when you're ready, unpause the video and I'll continue the lecture with you. All right, so as you can see, price has been meandering around in here, consolidating, and then finally made its way lower, and then it had another drop here little bit of a retracement in here, and price had a nice sell-off, trading down below the 32.08 level. If we break this down and add that same daily key level, that's that 32.56.5, and then we incorporate the aspects of time, because price by itself doesn't mean anything. It's not price and time, it's time and price. That's how the algorithm operates. It may sound like arguing semantics, but it's absolutely crucial that you understand that time is the first factor in how price is delivered. Once you have a specific window of time when the algorithm will operate and run on its macro, and again, a macro is a short list of processes that go in action for either running to a specific pool of liquidity or to a period of time where the market was inefficiently delivered and therefore rebalancing. They're the only two things that occur in price. It runs to liquidity, either buy side liquidity above old highs, or it runs sell side liquidity below old lows, or it runs to an area of inefficiency in the sense that it wants to rebalance. So with those two ideas in mind, I want you to remember that we are looking at the EMA S&P on the daily chart. I've already suggested that we should focus on delivery on the downside, so attacking sell side delivery. So you have to look for, where does sell side liquidity reside? Well, if you're looking at London open kill zone on Friday, and that begins at 2 o'clock in the morning and ends at 5 o'clock in the morning. Okay, so once we have that period on our chart, we're hunting in this area for a specific phenomenon. Now that phenomenon is what I talked about in the last video, where we have an order block, which you can see the price trades up to it here, here, that red line is what I'm referring to, here, 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 here. What's going on there? Is that resistance? Or is that an algorithm holding price at this level? They're accumulating short positions. So now if we are looking at this area up here and they're shorting, and again, they collectively are the real smart money, not Goldman Sachs, not Citi, but they're a lower rung entity in this grand scheme of things. Okay, so if we look at that area right here, the order block in itself, if we're using higher time frame, you have to wait for price to show its hand. What does that mean? Does it mean get right in at the order block? Not if it's a higher time frame order block, no. So you wait for time of day. Now we're in a kill zone, London. Wait for price to show willingness to go away, in this case lower, because order flow on the daily chart is bearish. So we're waiting for a displacement lower during 2 o'clock to 5 o'clock in the morning. Do you see it? Right here. This displacement right here. Now, right away, some of you that are familiar with my content would say, okay, you have to look at the up close candle or candles that are consecutive, like this one here, like 1, 2, 3. That would be your order block, your bearish order block. And if it trades back up to it once it trades below it, well, it does it here. And then do we get a little displacement? Yes, it starts to run. This one has already been used. So as we start to retrace higher, right in here, that candle is what you would be using for your order block. So you have this price run here, and then this order block. What's the low on that candle? You're going to look at this price right here, okay? Focus there. The low on that candle comes in at 32.43 even, okay? 32.43.00. The high on this candle comes in exactly at 32.43.00. Again, folks, perfect. It's perfect. It's not close. It almost made it. It's perfect. It can only happen that way if these markets are running on an algorithm. What time of day would this pattern form if it's running on a program. Well, a very specific element of time. That's why I teach the London open kill zone, the New York open kill zone, the London closed kill zone, and the New York closed kill zone, and Asia. That's how many opportunities exist every single day. You don't need to be a London open trader. If you can't be up overnight and you live in the States, then trade New York, or trade London close, or New York close, or Asia. But you don't need to be in London. But now, if you want to be a London trader, and you can use micro market structure concepts as I'm teaching in this series here, you want to be looking for a displacement lower, moving away from a higher time frame order block. We've already seen the inability for the price to get above that level, that red level. That's that order block on the daily chart. Price moves away. We have an order block. We trade up into it, and we have a very clear, obvious old low, which is sell side liquidity. So now what we're saying in essence is that we're looking for this area here to be matched up with this area here. So smart money operates under what I teach is market efficiency paradigm. That means when you look at the marketplace, when you as a retail trader look at price, you're looking at patterns, you're looking at indicators, you're looking for entry, and not so much on a stop loss, because most retail traders don't want to use a stop loss. They think if it stops me out, I'm wrong. Well, you need to have a shield. You can't just go in there with swinging a sword. You need to have a defense mechanism, and that is a stop loss. And that is what real professionals use. They don't trade with a mental stop or disregard it entirely. You have to measure and assume risk if you're trading in these markets. So it's good to train yourself to believe that what you're doing is the right thing to do, despite what many other people on the internet might tell you. So we have smart money selling short here. We're not looking at patterns. We're not looking at resistance support. We're not looking at supply and demand. We're not looking at Elliott Wave. We're not looking at any of that stuff. Okay. We're looking at the paradigm between where smart money would enter and where would smart money look to exit. You may not subscribe to the quote unquote they or smart money, but just for the sake of discussion, let's assume that they do exist. I believe they do, but let's assume that you don't believe it. But just miss all that for a second. If they existed and they're selling short up here, okay, they're selling as people are chasing this higher. Every time it makes a little bit of headway above that red line, buyers are using it as a breakout. They're buying. Who is giving them the other side of their buy? Their long trade. Smart money is selling that to them. So if the smart money is short, where's the ideal scenario for smart money to get out? A pattern, a harmonic pattern, an Elliott wave, a supply and demand zone, or the obvious counterparty to what they use to enter the position. If they are selling to buyers up here, they are going to look to pair their order for exiting that short with existing sellers. That's what's residing below here. Sell stops. So what they're going to do is they're going to sell short here and look to buy it back from willing sellers at a lower price that are just waiting to be tagged. So the market efficiency paradigm is this. Smart money sells, then buys it back from retail traders that have sell stops resting below old lows. Everything is upside down, folks. Everything that you think about the marketplace, everything you think about technical analysis, it's inverted. And you have to reverse that school of thought, and then everything will start falling into place. But as long as you struggle to defend your retail logic against people like me, you're going to break, and I'm going to be a frustration to you versus a help, because that's why I'm doing this. I'm not here to say, look how foolish all of you are, because I used to subscribe to this stuff too. I want you to test it. Look at it like this, and I promise you, if you spend 1 month looking at charts like that, all the retail stuff starts to feel foolish to consider. And then when you start looking at how the real professionals look at price action, everything makes more sense. It's not just simply, oh, it's a stop hunt. Oh, it's a support broken turn resistance. No, there's a narrative that's going on. And it's operating on a very specific element. I told you this level in the previous video. It was in your awareness. So we're not predicting a down close day. We're focusing on micro market structure. I get thousands of emails asking all the time, how was I doing those trades, buying and selling in the same day? Well, a lot of it has to do with things I'm not going to teach, but I will share some things and give you part of a view where some of the setups were framed on things like I'm showing you here, but not all of them though. So, and I think it's reasonable. Everyone out there should really accept the fact that if someone knows something and it's extremely technical and it's highly sought after, you're not going to teach everything. Okay, you're going to keep something for yourself and for your family. And I don't believe that's selfish, because I have spent 10 years teaching Forex for free. And while I do have a mentorship, I'm still here doing this for free. Okay, so again, take the value that I'm giving you, and you don't have to like me, but just look at it. I'm challenging you to look at your charts a little bit differently, and I promise you, you will improve. I promise you, you will improve. Like, it's a night and day difference once you see it. But what are we looking for specifically? We want to see the price move away, but not just drift away. We want to see it drive hard away, because what the indicators are telling you is something altogether different. Whereas if we're reading price is indicating, okay, yeah, we're reaching for something. And what we're reaching for is the liquidity resting below this low. Remember, the daily chart order flow is bearish. So I want to be looking at key levels and selling short with intraday volatility at a time of day when I know the algorithm will start really operating and running on its own macro. That means it's going to be reaching for a predetermined level that we can clearly see if we understand the market efficiency paradigm. That means we look at price how smart money looks at price. We don't look at patterns. We look on the basis of liquidity, imbalance, rebalance. That's it. That's it. There's either buy side liquidity run, sell side liquidity run, or inefficient run rebalanced, or run to make inefficient. That's the only things you need to understand about price. It's not an oversimplification, obviously, and it's not an overcomplication. They are 4 specific things. They're 4 pillars of understanding what price is doing. The 5th element is time. That's what we're looking at here. So we see price moving away from that order block. You don't need to be in at the order block. Don't think that you need to do that on a higher time frame level. You just need to see, do we have proof that price is wanting to go lower away from it? And we have that. Then we have consolidation, and then we drive lower. First level would have been here, so you could be short already there, and your stop loss would be there. But say you missed it. Okay, no problem. This price run here, where's the order block? There. So if we look at that and put a line right on that low, right there, the high, 32.43. The low, 32.43. Perfect delivery of price. Sell short there. And where is it going to go? Well, we're going to aim for a level below this swing low, because there's going to be what residing below there? Sell stops. Why should it go there? Think. Why should price from here drop below that low? It's not support, because that logic says if it's going to go down, it's going to go down to that level here and bounce. That's what I was taught in all the books I had. Think. That's what you're taught. If it goes down there, it's a buy. They're not teaching you to target that low and the liquidity below that. That's what I teach. That's what smart money traders do in indices and in stocks and in futures and commodities and bonds. You see where I'm going with this, right? You need to stop drinking from the pool because the water's tainted, and stop reading your books because those things are poisoning your perception. If we take the kill zone lines off, I don't have these things on my chart. When I look at price, there's nothing on the chart. Zero. Now I might make an annotation, a text thing for myself to remember a specific level, but I'm not drawing all this stuff out. I'm drawing all these things on my chart so it can be taught and learned by you. So you can visually see what I'm internalizing in the price. So when I'm looking at the price, I don't have all this stuff on there because, number one, it's going to be a distraction. I know in my head what I'm looking for. But you, as a developing student, learning my way of thought process, price action, institutional order flow, institutional trading, smart money trading, all that. For you to understand it, you have to see these things applied to the chart because it will solidify the concept. Over and over again, repetitive examples will just basically burn the image in your brain. But we have an optimal trade entry here. Okay, so we have this run here. So we have 1, 2, 3 candles up, and we have this swing low here. All right, so we have the fib on the high and the low, and you can see the 62% retracement level. Well, maybe you can't. It says 32.43.00. Perfect. Okay, again, it's not the fact that the Fibonacci, sweet spot, optimal trade entry, all that stuff. That's just from me to teach you a good area to aim for. It doesn't necessarily need to trade at that level for me to enter, but we can see that we trade to optimal trade entry, and if it breaks this low, how far can it go? Well, our target is something below this low here. So look at the fib. What's below that? We have 32.15.50, then we have 32.07 even. 32.07 even, that's what this line is here. And it trades down to that line here on this candle. The low comes in at 32.06.50. That's 1/2 of a standard handle in the E-mini S&P. Or basically we're talking about $25. So it was off by $25 in terms of projecting a low target that would be below here. I had a guy on YouTube. He made a comment in a recent video of his. He said, you're trying to tell me that ICT knows how far it's going to go below an old low? Yeah, just watch my videos. I'm teaching you right here. Anyway, the price has a nice run from 32.43 to 32.07. That's 36 handles in the Standard & Poor's futures contract. 36 handles, folks. When I was trading back in the 90s, and I transitioned from trading grains and live cattle and copper and all the regular commodity markets, I transitioned into bonds. And then by trading bonds, I got enticed into trading S&P. We had hoped that we would get 3 full handles for our trade. That was the type of volatility we had back then. 3. I just showed you 36 using this method. Okay? So we're applying an element of precision that nothing else out there delivers. And everyone that can watch my videos, and this is why folks don't like, and they thumbs down the video despite I'm giving you gold. Okay, I'm literally laying gold and lottery tickets in your hands for next week and months and years to come. But they don't like hearing me say nothing's like this and nothing's better. But folks, how can you improve on perfection? I mean, seriously, forget who I am. If you and I were just sitting here talking about any other topic and we clearly see an element of perfection. Perfection. How is that a stage to argue on? Anyone looking at this can see it's perfect. It's not flawed. It's not muddy. It works sometimes. It's working every day. Every day. So I'm here to keep you inspired and working towards improving. But if you don't study, all of these things don't really matter. It's just you're watching videos that are going to be watched by other people too, and they're going to start going into their charts and looking for these things that repeat over and over and over again. Now, once it gets below this low here, and it trades down and takes that liquidity out, the shorts that the smart money have traded with up here and looking to buy back below here to the sell stops that are waiting to be filled and triggered, once that's done, my intraday sentiment shifts. I'm now thinking, okay, we've ran sell side liquidity. Where is the nearest buy side liquidity? Here. And if it can run above here, what next would it target? It would target this. And what did they leave up here? Relative equal highs. So what's residing above here? Buy side liquidity. So in addition to closing shorts from up here below this low, smart money now is accumulating long positions. So they're going to buy sell stops with the intent that they're going to sell them to buyers up here with the buy side liquidity. So that's the market efficiency paradigm. You need to know by looking at the chart, day of the week, time of day, sentiment ideas, not sentiment in the sense that we're measuring it in an indicator, but based on what has recently transpired in price. Has it taken out stops that's below the marketplace? Okay, then it's either going to go up to rebalance something inefficient, or it's going to go up to take out buy stops. That's the only two things that can happen, folks. That's it. Nothing else. No patterns, nothing harmonic, no waves from Elliott, no Dow theory. Nothing like that needs to be referred to at all. It's liquidity, rebalance, imbalance. That's it. Buy side, sell side, inefficient delivery, rebalance to efficient delivery. And then add an element of time. Then you have the understanding of what price is doing. Now, there's narratives that you need to understand and how that fits in the grand scheme of things. But if we're talking about intraday volatility on a micro scale like this, then it's not that important as long as you have one key level that way you can operate on. And that level is this bearish order block. That's from the daily chart. But if you want to focus only in the direction of the highest probability trades and filter out possibly being wrong, going long intraday, then this is how you do it. But once you get your objective below the sell side liquidity, you're done. That's it. You don't turn it into a long-term trade. You're not a swing trader. You're not a position trader. You're getting out. You're collecting your chips, cashing in, and you're coming back the next day. That's how day traders live and thrive. They don't go in here and keep throwing dice. But let's take a look at what happened later on in the day. The sell side liquidity is taken, comes back down, hits that same old low, rallies up, and clears all the buy side liquidity above these highs. Here would have run into the close on Friday. So when you look at things like this, it should be very fascinating. At least it was for me when I started seeing it and studying it. When I saw these things in 1995, it changed everything for me. It made me feel like I should be expecting a knock at my door anytime. Like I had some forbidden knowledge. That's what it felt like. Okay. And it grew from here. And I got more insights and more details and more precision elements. And everything started coming together with this beautiful tapestry of amazing, highly detailed processes that the markets actually repeat and do every single day and every single week. Now, here's the wonderful thing. When you start knowing these things, you'll find that there are times of the year, seasonal tendencies, that specific markets will tend to do bigger moves. And you can use these elements like this to position yourself in trades that may be longer term. But if you're only going to be a intraday trader, you need to refine this art in this time frame only, and avoid trying to say, okay, well, I'm smarter than I really am, before you are, and overstaying your welcome in the position. You don't want to do that, because if you use the things I'm showing you here, you're going to find setups a lot. You're going to find lots and lots of setups. And you're not limited to just that daily chart for an order block to base your trade on. You can use a 4-hour chart. So you have a daily and a 4-hour. If you use that idea and just wait for these levels to give you an indication, what I've taught you here is to trade off of key levels with a bias relative to its time frame. So in other words, if the 4 hours been dropping, okay, that's even greater if the daily's been dropping. So you're really in sync with higher time frame order flow. You're not trying to predict the bottom, and if the market's been going up, you're not trying to predict the top, because intraday volatility is going to serve you well if you're just looking on the basis of running to an old low or an old high, because you're reaching for liquidity. You're still going to have losing trades. So if you make the mistake of trading with live funds with this idea, expect to lose money. You're going to lose money. Everyone loses money, period. You're going to have losing trades. Your stops are going to hit sometimes. The trade won't pan out. You'll be wrong. You'll read it wrong. Or despite it looking as if it's perfect, it will fail. It may not go anywhere. It may just go into consolidation. And then you'll have to have a time stop. How long are you willing to hold on to a trade that isn't panning out? Well, if we leave the kill zone in London and we start going into a time of day after 5 a.m. and it's not moving, it's best many times just to kill the trade and then wait for New York setup. Don't hold on to something that you're worrying about. And many of you probably trade during work hours, and you're really not being efficient for your employer. You're not being a good steward there, and you're making yourself miserable. So if you only trade during the kill zones, New York being 7 o'clock in the morning to 9 o'clock in the morning, there's your sweet spot. Or you can use the 8:30 to 11 o'clock optimal trade entry pattern recognition series New York session window. That takes in consideration the 8:30 news embargo lifting and London close. So you have two major factors there, providing a beginning and an ending where majority of the moves are going to occur, because you're letting price wait for the news events, whatever volatility is injected after that, until London close, and then volume starts to peter off on the daily for that particular asset around 11 o'clock to 12 o'clock. And to make it easy, it's 2 o'clock to 5 o'clock London open, 7 to 9 New York, 8:30 to 11 New York session, London close 10 to noon, in Asia's 7 p.m. to 9 p.m. And these are all Eastern Standard Times. And that's going to be pretty much it. And when you're trading late New York, it's the session I showed you using the equities afternoon trend. It's 1 o'clock in the afternoon to 4 o'clock in the afternoon, Eastern Standard Time. So that way you have all my kill zones. You have, again, the New York session kill zone. I don't want to call it a kill zone. It's the New York session for the optimal trade entry pattern recognition series. When I talk about when to look for it, that's a nice window of opportunity to look for it there. But in my own personal trading, there's lots of trades that I'll take between 7 o'clock and 9 o'clock in the morning that will be ahead of the news that comes out. And I don't always trade ahead of the news, depending on what type of news event comes out. It could be a high impact news event that says I'll wait for that. But if it's a medium impact news event, or no news is expected for that currency that I'm trading, or in this case indice, then I'm not worried about. I'll just take the trade before 8:30, and I'll anticipate 8:30 fueling the fire that I have already set between 7 o'clock in the morning and 8:30. So hopefully you got something out of this one. We'll continue this series and refine a little bit more and bring some more insights about order blocks, because apparently YouTube needs it, because there's a lot of misinformation going on. But you don't need to enter exactly at the order block. If you have a higher time frame order block, all you're doing is waiting to see if it's willing to move and at a specific time of day, and then find your liquidity pool and set targets. And that's pretty much it. Until next time, wish you good luck and good trading.